copy trade. Copy trade. Copy trade. Copy trade.
Welcome back with WeMasterTrade family, it's me Eden here, and I'm beyond excited to be with you today for another incredible live session. Whether you've been with us for a while or this is your first time joining, buckle up because we've got a jam-packed session full of insight strategies and the kind of tips that will take your trading game to a whole new level. Okay, so we've got traders tuning in from all over the world, and it's awesome to see everyone coming together to share, learn and grow. So let's keep that momentum going. Okay, so we've got special guests here who are here to share their stories and strategies that will help them rise to the top of the game. So trust me, you don't want to miss a single word. So first up, I have the honor of introducing Helen, an absolute beast in the Forex market. Helen has been mastering Forex trading for over 2.5 years, and she's here to share some seriously valuable insight with all of you. So Helen, how's it going today?
Hey Aiden, I'm feeling fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful approach I recently adopted. I'm eager to delve into some of the strategies I've been applied in the Forex markets.
So love that energy, Helen. I know that our audience is pumped to hear all about your Forex journey, but before we get into that, let's not forget about our next guest, Scarlett. Scarlett's been dominating the fund trading scenes, especially in the high stake weights of crypto and stocks. So Scarlett, how's it going?
Hi, Aidan. I'm equally excited to be here. This session always offers fresh topic for discussion, and today I'm thrilled to share some other strategies that have been effective for me in fund trading. It's going to be an engaging session.
So that's what we'd love to hear. So for everyone watching, make sure that you've got your notepad ready because Helen and Scarlett are about to drop some serious knowledge bombs and we'll be diving deep into their experiences, challenges and these strategies that will help them thrive in the fast-paced world of fund trading. Alright Helen, let's kick things up with you. You've been trading Forex for over a year and a half now, and I know the Forex market can be a bit of a roller coaster. So can you tell us how you got your start in Forex trading and what led you to choose WeMasterTrade as your platform?
Certainly, Aidan. I began Forex trading about 2 years ago. What captivated me initially was the market vibrancy and potential activities. The Forex market is exceptionally dynamic, and I was attracted to the concept that there always potential for success, regardless of the circumstance. When I first discovered the WeMasterTrade, it immediately resonated with me as a perfect match. The results they provide, including sophisticated technical analysis and access to real-time data, truly impressed me. However, it's where the community aspect that clinches it for me. WeMasterTrade plays a strong emphasis on aiding trader success by offering essential tools and support to advance regardless of your starting point.
So that's fantastic, Helen. It sounds like WeMasterTrade really helped you evaluate your game. Now, Forex is known for its volatility, and sometimes it can make or break a trader. So how do you handle the ups and downs of the Forex market without letting the pressure get to you?
A great question. Volatility can be challenging, but it's also where the real opportunity serves. The key is having a solid risk management plan. I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools help me to do that. Their real-time alerts and customizable risk parameters allow me to react quickly but with control. When the market moves fast, you have to stay calm and trust your strategy and not let emotion take over. And for me, that's where WeMasterTrade's feature really shines.
So that's some seriously valuable insight, Helen. Managing risk and staying cool under pressure is definitely key in Forex trading. Now, Scarlett, let's switch gears to fund trading. You've been crushing it for nearly 2 years, specializing in long-term strategies. So can you tell us what drew you to fund trading and how it differs from other forms of trading?
Well, absolutely, Aidan. Fund trading revolves around strategic long-term growth. It's not about seeking quick wins, but constructing a portfolio that can steadily advance over time. What truly distinguishes fund trading is the need to consider both short-term and long-term perspectives. Careful risk management is crucial while simultaneously keeping an eye out of emerging opportunities. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to well-informed decisions that align with my long-term strategy, even when the market presents unexpected challenges.
I love that. Fund trading definitely seems that it requires a lot of patience and foresight. So Scott, how do you stay focused on the bigger picture, especially when the market gets rocky?
Well, patience is paramount in fund trading. The market experiences fluctuations, but short-term ups and downs shouldn't dictate your long-term strategy. A crucial lesson I've learned is to maintain emotional detachment. Don't get overly excited when things are going well, and don't panic when the market dips. WeMasterTrade risk management tools assist me to stay disciplined even during volatile. I can set a precise risk parameter and have peace of mind knowing that I'm not overexposed, even when the market behaves unpredictably.
That solid advice, keeping your emotions in check, is definitely a big part of being successful in trading, and you both have shared some serious shams so far. But let's talk about the tools that will help you get to where you are today. So Helen, can you share one specific features on WeMasterTrade that's been a game changer for you in Forex?
Sure. A tool I absolutely rely on is the account insight features. It's offered up to the minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make better informed choice. Whether I'm pinpointing the bad time to enter the markets or deciphering the market trends, this tool gives me an edge. It has enabled me to spot opportunities that might not have noticed otherwise.
That sounds like a total game changer. Having that real-time insights is crucial, especially when you need to make quick decisions. So Scarlett, how about you? What's been your go-to tool in fund trading?
Well, for me, it's all about the risk management tools. They allow me to customize the amount of risk I'm willing to take on any trade. And this has been key for me, especially in volatile markets like crypto. WeMasterTrade helps me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded even when the market is going wild.
So risk management is really important, especially in today's fast-moving market. Whether you're in Forex or fund trading, having the right tools makes a lot of difference. And I hope that everyone is taking notes, because Helen and Scarlett are dropping some serious pro-level insight today. So next up, we are kicking things up a notch, because it's time to dive into one of the most powerful features here at WeMasterTrade, the package comparisons. So whether you're a fresh trade newbie eager to get your feet wet, or a seasoned pro looking to scale up your game to new highs, this segment is for you, because this is where you'll find the perfect trading package to match your goals and take your trading from good to great. So now let's be clear, here at WeMasterTrade we know this, that no one size fits all in trading. Every trader is unique with different styles, risk tolerance and strategies, so that's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. Whether you're aiming for high rates and high rewards, or you prefer this steady methodical approach, there's something here for you. And to break it all down, I've got the awesome Helen and Scarlett, two of WeMasterTrade finance. So we're both work closely with these packages and are here to give us the inside scoop on how to leverage each one to its full potential. So, alright, let's jump in, Helen. You've been with WeMasterTrade for a while now, and you've seen firsthand how these packages can evaluate a trader's experience. So can you kick things up by walking us through how both new and experienced traders can benefit from the package comparisons, and why it is such a game-changing feature in the WeMasterTrade experience?
Absolutely, Aiden. I really enjoy discussing this package because it's where traders can truly customize their experience. The package comparison feature simplifies the process for the trader to understand precisely that they are getting. When you visit the website, the detailed comparative overview of each package that include information like the initial balance, profit targets, daily loss limits, and more. All the essential details are presented in a straightforward, easy to navigate table. It's all structured to assist trader in selecting the best tool for their success. Okay, let's talk about the standard package, one of the most popular options. This one is great for traders who got some experience and are ready to level up. You start with an initial balance of up to $200,000 with you plenty of room to trade confidently and make a strategic move. The profit target is set as 6%, which is perfect for traders aiming for steady, sustainable growth. And a daily loss cap is 4%, so you got enough breathing room to ride out market swing without spreading too much. It's an awesome balance between opportunity and security.
So that sounds like a perfect stepping stone for traders looking to level up without jumping in too deep or too quickly. A 200,000K balance and a solid 6% profit target give you a ton of flexibility to build momentum. But for those who are looking for something a bit more thrilling, let's talk about the 5-10-10 package challenge. I feel that this one is a favorite for high-risk, high-reward traders. So what makes the 5-10-10 such a standout?
The 5-10-10 pockets, now we're talking a big place. Like the standard pocket, you start with $200,000, but this packet is for those traders who are ready to take on bigger risks or for the bigger regards. The daily long caps is 5%, giving you more flexibility in how you handle the markets. But here the kicker, the profit target jumped to the 10%. This is perfect for traders who have confidence in their strategies and are looking to make their major gains. It's all about having a higher tolerance for risk in exchange for bigger payouts.
So that's what I'm talking about, a 5% loss cap and a 10% profit target. That's definitely for traders who aren't afraid to go big and swing for the fences. But what if someone looking for something more relaxed? Maybe they want something simpler without all the pressures of hitting specific profit targets. So Scholar, I've heard about the 5-10-0 package. So can you break it down for us?
Absolutely, the 5-10-0 package is ideal for traders who want a straightforward, no-nonsense approach. You start with a $100,000 balance, but here's the cool part. There's no profit target. You can trade freely without a straight up hitting specific percentages. It's just you, the market, and your strategies. The daily loss caps stay at 5%, giving you some structure, but the beauty here is that it allows traders to focus on consistency without worrying about specific goals.
So now that sounds like a dream for traders who just want to try without all of the restrictions. Total freedom, no pressures, just you in the market. Now, Scholar, what about those traders who want a bit more control over their risk management but still want to play in that high stake arenas? So what can you tell us about the 5-10-10 no PC package?
Well, the 5-10-10 OPC package is perfect for traders who want more control over their trades. You still get a $200,000 starting balance and the 5% of daily loss cap. But the flexibility is the real selling point here. This package allows you to tweak and adjust your trading parameters to match your style and risk management preferences. Whether you're reacting to market changes or want to experiment with different strategies, this package gives you the freedom and adapt without losing a safety net of risk management.
So flexibility and control in a volatile market, that's huge, and I love how these packages are giving traders more ways to adapt and grow. Now we've covered a lot, but I've seen, hearing whispers about something really special, the custom package. So Helen, tell us, what makes this one so exciting?
Okay, the custom pockets is where things get really exciting. This is for the trader who want its own full controls, full customization, and massive static balance. You get the short whopping 1 million initial balance. Yes, 1 million. But that's just the beginning. The real beauty is that you can customize everything, the daily loss limits, overall loss limits, and even your profit targets. It's perfect for traders who know exactly what they're doing and want to grab a trading experience that matches their exact needs. This is the ultimate in freedom and control.
So $1 million starting balance and the ability to customize your entire trading experience, that's next level trading. And whether you're a risk taker or a methodical trader, the custom package sounds like the ultimate playground for those who want to take their trading to the stratosphere. So alright traders, let's quickly recap whether you're just starting with the standard package or going bigger rewards with the 5-10-10 package, or enjoying full freedom with the 5-10-0, or taking control with the 5-10-10 no PC, or customize everything with the custom package. WeMasterTrade has the perfect option for you, so the only question is which one is calling your name. So head over to the package comparison section on our website right now and check it out for yourself. We've got packages designed to fit every trader, no matter where you are in your trading journey. Let us know in the chat which package spoke to you, and our team is ready to help you get started. The future of fund trading is in your hands, so let's make it happen. Okay, so this is where your magic happens, traders. We've talked about the packages and how you can jumpstart your trading journey with WeMasterTrade. But let's be real, success in trading isn't just about the package that you choose. It's also about understanding and sticking to the rules of the conditions that we have set at WeMasterTrade are designed to not only keep you safe but also help you grow and take your strategies to the next level. So now, whether you're just getting started or you've been trading for years, these conditions will act as your roadmap. So let's start into the rules that will define our trading environment, because if you understand the rules, you can master the game. So first on the list, and arguably one of the most important, is the daily loss limit. So Helen, you've been through it all, the high, the low. So can you kick things up by explaining to everybody how this daily loss limit works and why it's so crucial for managing risk?
Absolutely, Aiden. The daily loss limit is one of the most essential protection any trader can employ. It serves as a daily schedule breaker to prevent you from suffering significant losses on challenging days. The concept is straightforward. Daily limit to how much you can lose in a single day of trading, and is determined by the reader of two values: your account balance and your equity at the beginning of the day. Let me break that down with an example so everyone understands it clearly. For the first example, let's say you got a balance of $105,000. If due to some open trade, your equity, including floating profit and loss, is $107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to $4,000. If your equity falls below $103,000, you don't trading for the day. The next example, on the flip side, if your balance is $100,000 and your equity is $99,000, it is a 4% loss limit. Could mean your account would be the liquidate if your equity dipped below $96,000. The point is the daily loss limit is there to make sure the bad day doesn't whip you out completely. It's about protecting your account and giving you the chance to regroup and come back stronger the next day.
So it's like an insurance policy for your trading day. You hit that limit and boom, you're out before things get out of hand. But what happens if a trader accidentally causes that lie? So can they keep trading?
Great question, Aiden. No. If you break the daily loss limit, your account automatically liquidates. Or your open position will be closed and you weren't able to trade again until the next day, or unless you buy a new trading package. Here is the thing, the liquidation is automatic and immediate. It's designed that way to prevent further losses. But here's a word of caution. Market fluctuations can sometimes cause you to lose a bit more than the limit, depending on how fast the market is moving.
So it's a hot start, definitely something traders should keep an eye on to avoid. And now that we understand what the daily loss limit is and what happens when it hits, but the next question is how to avoid hitting the limit in the first place. So Scarlett, you've been in the trading challenges for years, so can you share some practical strategies that traders can use to stay within that daily loss limit? We're all ears.
You got it, Aiden. Staying within the daily loss limit is all about being disciplined and following a solid risk management plan. Here are a few key strategies that have worked wonderful for me and countless other traders. First, I can't stress this enough. Always use a stop loss. I know it sounds simple, but it's absolutely critical. The stop loss ensures that if the market moves against you, you're out of the trade before things get out of hand. Think of it as your safety net.
So that's like setting up guardrails on a mountain way, right? Is that to stop you before you go off the cliff?
Exactly, Aidan. It's that extra layer of protection. Now, the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single day. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you're still far from hitting your daily loss limit, and you can keep trading without any major setback.
So it's like building your defense, you don't put everything in one play, right? You spread out the risk, that actually makes sense. But what about those moments when traders feel tempted to chase after the losses, trying to get it all back in one trade?
Oh, that's a big one, Aidan. Chasing losses is one of the biggest mistakes traders make, especially newer ones. This brings me to my third strategy: don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow. If you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that lead to even bigger losses. And before you know it, you'll hit that daily loss limit and you're out for a day.
So true, it's like trying to run when you're ready. When dead, you're more likely to make a mistake. Now, Scarlett, these strategies sound spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them from falling into that emotional trap of chasing losses?
Well, it's all about mindset, Aidan. Trading is just as much a mental game as it is a numbers game. You got to stay calm and focused. One trick is to always have a trading plan before you even place a trade. That way, when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop. Take a break, step away from the screen, and reset your mindset.
Thank you, Scarlett, for those incredible tips on managing daily loss. Now, let's shift our focus to another critical element of risk management, the maximum loss limit. So this limit is like your long-term safety net, ensuring that you don't deplete your account over time. So unlike the daily loss limit, which resets at the end of each day, the maximum loss limit is cumulative. So when you reach it, your account will be locked and your trades will be closed. So to dive deeper into this, let's discuss how the maximum loss limit works, how it's calculated, and why it's essential for traders at every level, whether you're a new trader looking to minimize risk or an experienced trader scaling your strategy. This limits ensure that you don't go beyond a point of no return. So Helen, I know you've got some great insight into the mechanics of the maximum loss limit. So could you walk us through how this rule works and what traders need to keep in mind as they plan their trading strategy?
Of course, Aidan, the maximum loss limit is a virtual rule that often overlooked, but extremely important. Essentially, it's there to prevent traders from experiencing catastrophic losses by capping how much you can lose across the life of your trading account. Let's break it down. The maximum loss limit ensures your account equity never falls below 94% of its initial balance. So if you start with a balance of the $50,000, your account will be closed when your equity falls to the 47,000. That the total allowable loss of 3,000. However, it's not all bad news. If you start making profit, the limits adapt, giving you more breathing room at your equity growth. For example, if your account's balance increased to the $52,000, you now make $2,000 in profits. The new maximum loss limit would then allow you to lose up to $5,000 as you are essentially locking in those gains. The maximum loss limit as a long-term safeguard. It is designed not only to protect your account but also to encourage disciplined trading by setting barriers. The goal is to ensure you don't dig yourself into the hole that's too deep to recover from. Here is a few specific examples. For the first example, let's say your account balance starts with $50,000, but your equity dropped to the $49,000 due to some market losses. You allow to lose another $2,000 before your account hit the critical $47,000 threshold and automatically close. The next example, now if you're doing well and your equity rise to the 15,000, you got some extra cushion. At this point, you are allowed to lose up to $4,000 before your account hit that same $47,000 limit. To figure out where you stand, the maximum loss limit is calculated by adding sum of your close position and factoring in any position that you are still running. Your trading dashboard will show two key metrics: max permitted loss, how much you are allowed to lose overall, and remaining loss, the loss left before your account is closed. Now, what happening if you hit that limit? Well, unfortunately, if your equity hit the maximum loss limit, the system will automatically close your account for the day, or your open position will be liquidated, whether you the profitable or not, and you will be unable to trade for the rest of the day. To resume trading, you would need to purchase a new trading package.
So thank you, Helen. That's definitely helped clarify the nuts and bolts of the maximum loss limit. So next up, we're going to enter a short break, and that after that, we're going to explore some of the promotion plan that we're currently running.
Trade. 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 We copy trade. We copy trade. We copy trade. We copy trade. Trade. Copy Trade. Copy Trade. Copy Trade. Copy Trade. copy trade.
So next up, we're going to bring in Scarlett, a risk management expert. So Scarlett, what do you think are the most common mistakes traders make when it comes to managing their maximum loss limit? And more importantly, what strategies can traders implement to ensure they never get too close to it?
Well, great question, Aiden. You're absolutely right. No matter what type of trader you are, ignoring the maximum loss limit can be costly. In fact, it's one of those things that can sneak up on traders who aren't paying attention to long-term picture. And I'd say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. Here are some key strategies I recommend to stay well within your maximum loss limit. First, this is your first line of defense. Setting a stop loss means you're designing in advance how much you are willing to lose on a particular trade. The system will automatically close your trade if it hits that number, which protects you from letting a losing trade get out of hand. For example, if you're only willing to lose $500 on a particular trade, you set that as your stop loss, and you won't have to worry about it spiraling.
So I love that it's like putting a safety valve in each trade when you look and that stop loss is out of your hand.
Exactly, Aiden, it's all about discipline. This is a big one often. Traders, especially newer ones, can carry away by putting too much capital into a single trade. But when you risk too much, you also risk losing a larger percentage of your account if the trade goes south. A good rule of thumb is to risk no more than 1 to 2% of your total account balance on any single trade. For example, if your account balance is $50,000, you should only risk about $500 to $1,000 per trade. This keeps your potential losses manageable and well within your limit.
So that makes total sense. You're not putting all your eggs in one basket, and it gives you more room to breathe, right?
Exactly, it's all about spreading the risk so you don't take too big on a hit on any one trade. Next up is monitor your account equity regularly. This may sound basic, but is incredibly important to keep an eye on your account equity throughout the day. It's easy to get caught up in the market highs and lows, but you should always be aware of how close you are to your maximum loss limit. Your dashboard makes it easy to track your remaining loss, and so use it. If you see that you're getting close to the limit, it's time to take a step back and evaluate your strategy.
So it's almost watching a field goals. You don't want to be driving on film without knowing it.
Exactly, and no one wants to get stuck on the side of the road. Next up is create and stick to the trading plan. Having a well thought out trading plan is one of the most powerful tools in a trader's arsenal. This plan should outline not only your profit goals but also your risk management rules. For example, if you have a few losing trades in a row, does your plan tell you to take a break, reassess, or change your strategy? The idea is to have a preset series of rules so you don't make impulsive decisions in the heat of the moment.
So it's like having a roadmap, right? You know where you go. You have the continuity plans for when things don't go as expected.
Exactly. The market can be unpredictable, but a solid plan keeps you grounded. So next up, you need to regularly review and adjust your strategy. Even the best laid plans need to be reviewed and tweaked from time to time. So if you find that you're approaching your maximum loss limit too often, it may be a sign that your risk management strategy needs adjusting. Maybe you need to tighten your stop losses or reduce your trade size. The key is to stay flexible and adapt to changing market conditions, while always keep your risk in check.
So that's great advice, Khaled. It's all about constant improvement. You can't just set it and forget it. You've got to be ready to adjust based on your results in the market.
Absolutely, trading is dynamic and your strategies should be too.
So thank you for the fantastic breakdown of the maximum loss limit, Helen and Scarlett. This is perfectly into our next case topic, the profit consistency rule. So this rule is critical for ensuring long-term sustainable success in trading, as it helps measures to maintain consistency in your profits. Now, to give us a clear picture of how the profit consistency rule works and why it's important, let's turn to Helen. Helen, can you break the rules down for us? How is this calculated and why it is so important for traders to focus on their consistency rather than, just for big wins?
According to Aiden, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making big gains, no one or two good days. It's about being a consistent day in and day out. So here's how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total of your profit and losses over a given period, usually a month or a quarter. You then express that results at a percentage. Let's go through an example. Say your bad day brought in $200 in profit, but over the month your total profit and losses add up to the $410. In that case, your profit consistency ratio could be about 49.7%. This ratio shows how much of your performance comes from one standout day. Actually, you want this percentage to be lower under 20%, because that means your profits are more evenly spread out across on your trading days. Now, why is this important? A low profit consistency ratio indicates that you're not just relying on a couple of big wins to stay profitable. Instead, you're showing that your strategy works consistently over time, even on the those days when the market isn't giving you the big wins. This kind of consistency is the hallmark of a successful long-term traders.
So that's a great explanation, Helen. Just to clarify, a lower ratio means that you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Exactly, Aiden. When you too reliant on just a few big wins, it often means that your strategy is risky or inconsistent. You could go through long stretches where you are not making much money or even losing it. But if your profit consistency ratio is low, it shows that your performance is smoother and that your trading is more predictable and stable over time.
So that's incredibly insightful, and it seems like a critical metric for any traders who's serious about long-term success, right?
Exactly. Consistency is the key to sustainable profitably. Big wins are great, but if they flow by big losses or long period of break-even trading, it's hard to maintain momentum. With the profit consistency rule, trader can keep an eye on how reliable their strategy is over time.
So also now that we've got a solid understanding of what the perfect consistency rule is, so let's dig into some practical strategies to help traders maintain a low ratio, easily under 20%. So Scholar, I know if you've got some great tips for us, so can you work us through some techniques that traders can use to stay consistent and ensure their ratio stays in check?
Absolutely, Aiden. The profit consistency ratio is a powerful indicator, but it takes careful measurement to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those rare big wins. First, one of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investments across different markets, asset classes, or even trading strategies. So if you only trade one market, say Forex or stocks, you risk being too reliant on that market's performance. By diversifying, you reduce the impact of any single loss and create more in your overall performance.
So this makes a lot of sense. So if I'm only trading in, let's say, the US stock market, about we could really hit my profit consistency hard, but by adding trades in, for example, commodities or Forex, I could balance that out, right?
Exactly, Adam. It's all about balance. When one market isn't performing well, another market may be doing better. This way, your overall performance stays, and you're not relying on just one or two trades to pull you through. Next up is position size. One of the biggest mistakes traders make is over leveraging, taking on positions that are too large related to balance. For example, if you have a $10,000 account, putting $5,000 into a single trade is risky because if that trade goes south, you could lose a significant portion of your capital. Aim to keep your position size small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and helps ensure that losses don't overwhelm your profits.
So it's not just about picking the right trades, but also making sure you're not putting too much of your capital at risk on every single trade. Smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and discipline. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to get caught up in the emotions of trading, whether that's the excitement of a potential win or the panic of a sudden loss. A solid plan outlines exactly when you're enter a trade, when you're exit, and how much risk you are willing to take. Having these rules in place keeps you grounded and helps ensure that your trading decisions are consistent, which in turn helps keep your profit consistency ratio in check.
So that's a really good point. A lot of traders, especially new ones, probably jump into trades without a solid plan and end up making emotional decisions, right?
Absolutely, Aiden. It's so easy to get emotional in the heat of the moment, but if you have a plan, it's much easier to stay disciplined and avoid impulsive trades that could hurt your performance. So this brings us to stop loss orders. A stop loss is an automatic exit that you set up to close a trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. This using stop loss orders, you can avoid those catastrophic losses that can throw off your profit consistency.
So I like the ideas of using stop loss orders. It's like a way to take the emotions out of the decision-making process.
Exactly, it's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you stick to your plan and avoid large unexpected losses. So another important strategy is to regularly review your performance. Just because you set up a solid plan and strategies doesn't mean you should put everything on autopilot. It's crucial to track your trades, see what's working, and make adjustments as needed. you might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So performing maintenance in your trading strategies, always looking for ways to optimize and improve.
Exactly, just like a car needs regular tune-ups, your trading plans does too. Continuous improvement is key to keeping your profits steady. Finally, this is a big one: avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. If you stick to your strategy and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
So that's such an important point, saying calm and discipline even when the market is going crazy. It's easier said than done though, right?
It definitely takes practice, but staying level-headed is crucial for long-term success. If you can control your emotions and stick to your plan, you'll be far more likely to maintain consistent profit.
So next up, we're going to enter a short market analysis of today. So can our traders help me with this?
Sure. So, so the first news for today is affected currencies and countries. Due to bank holidays in this country indicate that their respective financial markets, including stock exchange, bond markets, and banking institutions, will remain closed or operate on reduced schedules. So the impact on financial market with the trading volume and liquidity. So with many major economies observing bank holidays, global markets will see significant reduced liquidity. Currency pairs like NZD and USD, AUD and USD, EUR and USD, GBP and USD and CHF will experience lighter trading volume. This may lead to less stable price movements with the potential of sharp spike or erratic behavior if unexpected orders hit the market. Cross-currency pairs such as EUR and GBP or AUD and NZD may see even lower activity. And on stock and commodity markets, equities tied to these regions will see little to no movement as stock markets in these countries will be closed. Commodities like oil and gold, which are often influenced by global demand, might see lower trading activity despite the presence of US traders. And the impact on investors. For large-scale institutional investors managing large portfolios and may avoid making significant trades due to concerns about low liquidity, which can increase the cost of entering or exiting positions. For equity markets in regions observing holidays, there will be no price changes, so investors in these countries may use the break for strategy planning rather than trading. And for retail retail participants might encounter limited opportunities to execute trades or may deal with wider bid-ask spreads, making short-term trades less attractive. An impact on traders, the day traders, the lack of market activity in major regions limits opportunities for intraday trading, scalping, or momentum-based strategies. They might instead focus on U.S. market or on major economic release, such as U.S. unemployment claims data. And for Forex trader, Forex market volatility will likely be subdued due to the absence of institutional flows from key economies like the Eurozone, UK, and Australia. However, the thin liquidity can amplify the impact of news or unexpected events. Impact on economists. Well, for economic analysis, bank holidays generally provide a quiet period for economists to review past data trends, assess policy impact, and prepare for future analysis rather than expecting new developments. The closed market means fewer data points for the day, leading to limited insights for short-term market behavior in affected regions. And for central bank monitor, well, central bank in holiday affected regions will not release report or take policy action, allowing for a pause in global monetary policy related developments.
Okay, I will continue the next news. The U.S. unemployment claims. This is a high impact event. Employment claims are quickly economic indicator that provide insight into the health of the U.S. labor market. Deviation from expectations can have a substantial implication for the U.S. economy, influencing investor sentiment in the Federal Reserve's policy outlook. Impact on financial markets. For the currency market, the U.S. dollar is likely to react strongly to the unemployment claim data. A lower than expected figure typically strengthens the USD as a signal at resilient labor markets. Conversely, higher than expected claim may weaken the USD, prompting investors to shift towards safe haven currency like the Chinese yen and Swiss franc. Equity market. Positive reports, fewer claims could boost investor confidence in the U.S. economy, leading to gain in the equity index like the S&P 500 and NASDAQ. A disappointing report may weigh on the equities, particularly if it heightens fear of economic slowdown or recession. Commodities. Safe haven itself like gold may gain if the report is negative, as investors seek protection from the potential market turmoil. Oil price may see limited impact unless the data trigger a broader market reaction regarding U.S. economic growth expectation. Impact on investor. For the short-term investor, high-frequency trading firms and short-term traders will focus on the employment claim data as it provides actionable information for immediate market movement. For the long-term investor, while the quickly claim data is important, long-term investor will play it in the context of broader economic trends such as wage growth, inflation, and the Federal Reserve policy. Impact on the trader. For the Forex trader in USD pair like EUR and USD, GBP and USD and JPY, we prepare for volatility around the report release time. The liquidity caused by bank holiday in the other regions may amplify the market reaction to the unemployment claim data. For the stock market trader, equity trader will monitor how unemployment claims influence sectors most sensitive to economic health, such as consumer, discretionary, and technology. Impact on economic. Economic will scrutinize the unemployment claim data to grow the strength of the U.S. labor market and its implication for the consumer marketing and broader economic growth. A positive report would suggest that the U.S. economy remains on a solid footing, supporting the Federal Reserve case for the maintaining or attracting interest rate based on inflationary pressures. A negative report may raise concern about a potential layoff, particularly if it follows the other week's labor market indicator. That's all the news for the day.
Thank you all for joining us today, and we hope that the session has been informative, that as you are excited about the opportunities here at WeMasterTrade as we are. So remember to like, subscribe and share this live stream with others who might benefit from it. And don't forget to follow us on our social media for more updates, promotion and trading stuff. Stay tuned for our upcoming events. We look forward to seeing you again soon. Until next time, happy trading!
Trade. Trade.